All right. Well, today we are using our time to talk about HELOCs. And in particular, we're talking about the HELOC that I use to pay off debt and build wealth. This strategy is known as velocity banking. So we'll hop into that in just a minute. But first of all, let's talk about what in the world is a HELOC. All right, so a HELOC stands for Home Equity Line of Credit, HELOC. And typically this is something that you would get after you have a mortgage, although it can be used on properties as the only lending for that particular property. We call it a second position if there's a mortgage in position already ahead of it, or we call it a first position HELOC if there are no other loans against or liens against the property. All right, so when we look at how to determine what your HELOC balance or limit would be, we have to understand where we're going to get the HELOC. So you're going to have to go to a bank or a credit union, and they will have rules depending on the bank or the credit union on how much they are able to lend out based on the value of the home. And so the term is loan to value, LTV. And typically, not always, but typically, banks will lend up to 90% of loan to value on your primary home. If you're using this strategy with rental properties or places you don't live full time, that number can drop. It can sometimes go down to 70%. So just really depends on the situation. But for your primary residence, 90% loan to value is a pretty safe place to start. Typically, you're charged an interest rate. The interest rate is typically based on the prime rate of the feds. So if they set the prime rate at 3%, you might end up with the 3% plus an additional 3 to 5%. So you may end up seeing a floating interest rate somewhere between 4 and 10%. Right now, so I'm recording this in 2022, the very end of 2022, the interest rates have gone up considerably in the past quarter. And so the interest rates on these HELOCs have also fluctuated as well. Your interest is calculated not based on your standard monthly payment like your mortgage, but actually it's based on your daily balance. So it's very much like a credit card. They take your annual rate and they divide it into 365 days, and they apply that rate to each day. They then accumulate all of those interest payments basically into one monthly payment that they then charge you. Your payment is actually just the interest. You can pay as much or as little as you want towards the principal, but you are required to pay the interest on your balance each month. So in a situation where you owe a large chunk of money, the more payments you make and the more frequently you make payments, the less you end up paying in interest. So unlike your mortgage, which you only make one payment per month, on a HELOC, if you made multiple payments throughout the month, you would reduce how much actual interest payments you make over the course of the month or the year. So with HELOCs, you're only really charged each and every day for what you're using on that day, which gives it a very distinct advantage over a mortgage when you think about the fact that your mortgage balance is static. You make one payment and that balance stays the same for the entire month. So even though you are receiving income as you are working your job, the income you receive is not affecting the balance on your mortgage unless you're making extra payments. And most of the time, people are making once a month payments on their mortgage. With that, if you decide I'm going to use this in addition to my home mortgage, the HELOC typically allows you to direct deposit paychecks. So the strategy is known, well, we'll jump into strategy in just a minute. First of all, let me give you an example of the loan to value. So if you have a home value of $200,000 and your mortgage is at $125,000, The loan to value at 90% would be $180,000. So if you take your loan to value and you subtract your mortgage, you would have $55,000 available. Now, based on your credit history and your situation and how well you know your bank or your credit union, they may offer you all the way up to this $55,000 limit. And in the cases that I've seen, at least in my own life, I'm working with a banker. I'm calling the banker up. I'm talking to them about my situation. I'm letting them know what I'm up against, what I'm dealing with, and how I want to use those funds. And then they basically just kind of approve me for the balance or the limit that I could have on my line. And then it goes through underwriting. So in this case, a $200,000 home, you can get up to $180,000 total between the HELOC and the mortgage. This case, you could get up to $55,000 in a HELOC. Now, you don't want, in this strategy, you do not want a second position home loan with the same monthly payments each month. That is a totally different situation because as you make payments, it reduces your balance, but it does not allow you to then go back and use that money again. Whereas with a HELOC, you get this $55,000 credit limit, basically. It's like a credit card in some ways. You go spend the money. Let's say you buy something, a car for $10,000. Well, now you're just paying interest on the $10,000 that you have borrowed. Whereas if you were to get a second position home loan, you would actually take out the full $55,000, and then they'd set you up with monthly payments based on how long it's going to take you to pay it back and what interest rates are. Now, the benefit to that would be you get all the money up front and you can lock in an interest rate. And that generally is a little bit safer to some people just because they know what their interest rate will be today, tomorrow, throughout the entire payment of the loan. However, you maybe don't need all $55,000 all at once. Maybe you're just cashing it out so your bank account is larger at your checking account, or your checking account has a higher balance. And the problem is if you really just needed $10,000, now you have $45,000 of equity that you pulled out of your home, and yet you are not using it for anything. So you were not paying interest on that money until you pulled it out. So with a HELOC, if you decide not to use it, it's sitting there in reserves. You can spend that money whenever you want, but you don't actually pay any interest or any monthly payment. So when I look at getting a HELOC, I look at it as a fairly simple and fairly low risk option, because the only risk you have is that you're going to go spend that money in an unwise way. So once we kind of figure out how to spend money wisely, a HELOC is a great tool to have. All right, here we go. Like I mentioned before, there's a strategy called velocity banking where you use a HELOC or a credit card or a personal line of credit, which I'm not talking about those today. Those are outside of my realm of experience. So I'm sticking with what I know from experience. Velocity banking says, why don't you take money that's available to you through your HELOC and use it to pay large chunks of money towards your debt. You can put your paychecks direct deposited into your HELOC, which brings down how much you owe, and it's as soon as those deposits come in. So let's say you're trying to pay off a car, a student loan, your house, and a credit card. What you're trying to accomplish is you're trying to create more cash flow each month to put towards these debts. This has been popularized by Dave Ramsey as the debt snowball. This, on the other hand, takes the debt snowball concept of paying off the lowest balance of your loans first, because then you end up creating more cash flow. So if you had a $200 payment towards a car and you pay off the car balance, now you have $200 more each month that, instead of coming to you when you get your paycheck and you keep it in your checking account, and you see it as, oh, I've got $200 extra this month, I might go spend it. What's actually happening when you convert over to velocity banking is you run all of your expenses and all of your income through the HELOC so that you're basically going from having a balance in a checking account to having a negative balance, a loan or a debt balance in the HELOC. And so the goal is to continue to reduce the balance in the HELOC in large chunks because your paycheck gets deposited into your HELOC directly. So the reason why this is hard for some people to figure out and to get their minds around is that it's really a shift in thinking to go from, let's say you like to keep $10,000 bare minimum in your checking account just so you feel safe. It's a big leap of faith to say, I'm going to take that $10,000 and put it towards a debt, and I'm going to actually keep only like a few $100s in my checking account and put the rest of it into my HELOC. What it essentially accomplishes for you is it helps you to see that all of your debts are impacting you, even if you have $10,000 in a checking account. Because the $10,000 in the checking account, the only purpose that it's serving is to be a safety net if something goes wrong. So why not use the equity that's already in your house as your security blanket, as your rainy day, something bad just happened emergency fund? If I've got this example, $55,000 in the ability to spend it if I need to, I can be more aggressive with whatever savings I have, and I can put that to work. So if I have a 15% credit card balance and I want to try to pay that off, having $10,000 applied to that balance would be amazing, because the 15% is a lot of interest to be paying. But if I'm using that as my emergency fund, I can't spend that on my credit card. I've got to save it for a rainy day or something bad happens. With Velocity Banking, you can allocate that $10,000 to pay off your debt, and all of a sudden you've released that monthly payment and you've reduced how much interest you're paying. Because typically a HELOC will float somewhere between 4 and 8 maybe percent, 9 maybe. I know right now the one I have is at 7%. It was for a very long time at 4.5 to 5.5% until just recently. So to me, looking at a student loan at 6% or a car loan at 5 for 6% and saying, I'm going to actually just convert this over and debt consolidate. I'm going to take those debts and throw them into a HELOC. Boom. All of a sudden I've reduced the total amount of interest that I'm paying just on the rate side of things, not even in considering the fact that the paychecks I'm taking in every month are paying it off faster. So here's how you would go about doing this. You'd go out and you'd get your HELOC. Typically, we'll talk about this, but typically you'd want to just do some searching, some shopping around to see who out there has the best deal for you when it comes to the HELOC. Sometimes you can get an introductory rate. Sometimes you can get extra perks or benefits. But typically you're looking to acquire a HELOC in either the first or second position. So it can either replace your mortgage payment and be a first position HELOC, or it's a second position and it just is addition to what you already have. And there's some benefits both ways. I mean, we can kind of talk about that on a different video. So here's an idea. You take your monthly cash flow. So this is where you do all your income, all your expenses, you see how much you keep at the end of the month. Then you take that dollar amount and multiply that by 12 to get your total cash flow for the whole year. This would be the maximum chunk that you would take, because you would not want to go so far into the debt repayment that you can't reduce your HELOC balance back to zero within a year. The idea would be look at it in 1 year periods of time. So in this case, let's say your cash flow is $500. You would multiply that by 12 months and you would end up with $6,000. Okay, so what that would mean is you could take a chunk out of your HELOC of $6,000, and with your current cash flow, you would be able to repay that balance down to zero in 12 months. Pretty cool. The cooler thing about a HELOC is that if you used that $6,000 to pay down your bills and you were able to eliminate, let's say, a car payment, and you had an extra $200 or more in your cash flow each month, you'd actually cut that cash flow chunk. You'd actually repay it a lot faster than 12 months because you'd be taking your 500 and you'd be adding an extra, let's say 250 for a 750 instead of 500. You see how all of a sudden, as soon as you pay off a balance in full and you receive the ability to use that cash flow to hit that next debt, you speed up this debt snowball. It's so, so cool. The next rule is the 2/3 rule. So when you are using a HELOC, it's considered a line of credit. And so when you run your credit score, they are going to look and see like how long you've had a debt open. They want to see if you've been making payments regularly. They want to make sure that your total loan amount is not right up against your limit. So the loan to limit ratio looks the best if you keep your HELOC balance to below 66%. There are some situations where it makes sense to go above 66%. But typically, if you want to be conservative and you want to protect your credit score as much as possible, it would be a wise decision to just kind of figure out what your 66% or your 2/3 would be on your HELOC. So let's say you got a HELOC for $30,000. This would mean you could spend up to $20,000 and reserve that $10,000 as a way to keep your credit score in a good place. All right. Now, where do you go to get a HELOC? I say the best option is a credit union. You can look at one in your town, a local one, a statewide one. So there might be one that's just in a state or a region or a regional one. But really what you're looking for is a credit union usually, because typically they're able to lend up to that 90% LTV, sometimes even 95% LTV. And one of the reasons why they can do that is because they typically require you to open multiple accounts and become an owner of the credit union. So they need you to have a savings account or a primary shareholder account in the credit union, and then you're kind of able to access the other lending opportunities. And so the one I use is called Truestone Credit Union, and it's based out of the Twin Cities area in Minnesota. And what I've been shocked to see is that these HELOCs really do not cost a lot of money to get started. I have done refinances before with my mortgages to get better interest rates. I did one where I went from 30 years to 15 years to try to speed up the repayment process. And generally those cost a few $1,000s every time you do it. But for a HELOC, what I've seen is like a $99 fee does the whole thing. If you add on an appraisal to try to get a true picture of what your home value is, so if you really want to get right up to that maximum, that 90% LTV or 95% LTV, the bank or the credit union, they're really going to want to get an accurate appraisal to know that they can lend that much money to you. However, if you are going for a smaller loan to value, let's say you only need a 50% loan to value or something like that. The last one that I just got, I just really upped my HELOC to get a higher interest, or sorry, a higher limit on my HELOC. They actually just ran a computer report to see what a general range of value my home has. And they just took a conservative estimate on the range of value, which was a large range, in my opinion. And I feel like they were pretty conservative. They put my value pretty low. But because I didn't need to access the entire equity package, I just wanted to get to they had a max at my credit union. They said, if you get up to 175,000, we can approve that with minimal underwriting. But if we go above 175,000, we're going to need to do a full appraisal and it'll go through a different underwriting process. And so I said, well, I'm cool with just taking the $175,000 max, even though my equity would have allowed me to go higher, because I wanted to just keep it simple. I didn't even want to pay the appraisal fee. They just charged me $99 to do this process and expanded my spending limit. And I'll get to my own story here in a minute. But what I've really liked about HELOCs is just very easy to get into. All right, here's what you need to know. If you're looking for a HELOC, you're looking for perhaps a credit union. I would say most likely that'll be your best bet. You want to see that they have an online banking app. So Truestone Credit Union, they have a banking app where you can switch between all of your accounts. So I've got a shareholder savings account, I've got a checking account, I've got a credit card, and I have a HELOC all on that one app. And I can transfer money between those accounts instantly. No limit. As long as it stays within the credit union, I can switch them between those accounts as much as I want. So when I run my expenses through my credit card, I can make a credit card payment for my HELOC. And all I have to do is just transfer funds from the HELOC to the credit card once a month. And now I paid my credit card bill. It's as easy as that. If I ever needed to, if I ever wanted to put a little bit more debt on my credit card for some reason and actually pay down my HELOC, it's not really that wise of a decision because your credit card percentage is a lot higher. Make space on your HELOC. You could pay down your HELOC with your credit card even, and there were no fees associated with that. So it's nice to have an online banking app. You can switch between accounts. You can transfer things easily. And the cool thing about mine is there's no restrictions on how much or how often I can take the money out or how I pay it back. I could literally make as many transactions in a month as I want. As far as I know, I've not had any problems with this. But there are some that require you or have a maximum number of transactions per month, or they may tell you you need to put a certain balance on the HELOC at the beginning in order to qualify for it. But the best HELOCs that are out there have an low introductory rate, like 2% or 3%. They have the features of a a checking account where you get a routing number and account number. And so if you have a routing number and account number that's directly connected to your HELOC, you also get a checkbook. You can write checks from the HELOC directly, and you can get your paycheck direct deposited right into the HELOC. Now, if you find a HELOC that you really like, but it doesn't allow you to function like a checking account, just set up a checking account in the same credit union that you can transfer funds between the HELOC and the checking account. So you could basically just say, oh, I need to write a check for $200 today. I'm going to transfer the money from the HELOC to the checking account to make sure I have $200 to write the check. Piece of cake. Or if you get your paychecks deposited into your checking account, you just take that amount that comes in, and on payday, you go into your banking app and you make the transfer over to your HELOC so that it reduces the balance as quickly as possible. I personally like to automate as much as I possibly can. So if I could pay bills automatically, get my paychecks done automatically, and if it can all go into the HELOC automatically, that makes things so much easier. And when you're doing a strategy like this, the speed that you make these transactions really does matter. If you, for some reason, forgot to move your paycheck into your HELOC, and you let it sit there in the other account for 5 or 6 or 7 days, you're actually increasing how much interest you're going to pay because you didn't move it over fast. So it's kind of a game. You have to remind yourself to keep that balance of the HELOC as low as possible to try to reduce how much interest you end up paying. All right, how I've used a HELOC. I'm going to take you on a journey. So I've bought a few different houses now. I'm on my third house with my family, and I've never had a HELOC for my first or second houses, but for my third house, we purchased it on a conventional loan. And my loan officer mentioned to me at closing, he said, well, you've made a down payment that allows you to access some of your equity through a HELOC. Even if it's like $10,000 or $15,000, you could just get a HELOC right away and have some extra funds available to spend if you need to. So here's an example. You put 25% down on a house when you buy it. That means you instantly have 25% equity. So if a bank is going to lend you up to 90% loan to value, you're basically built in with the opportunity to access 15% of that 25% equity if you did a conventional loan. So that's why he offered it to me. At the time, I was like, I don't know why I would even need a HELOC. So I totally just said, I don't know. I don't know anything about HELOCs. I don't want to deal with it. It sounds like extra debt, extra work, all that. So I let that thought go for a while. Well, then about a year later, maybe not even a year later, 6 months later, we had an outbuilding at our property that needed new siding. It was going to be $18,000. And I didn't have $18,000 saved up, but I remembered what that loan officer had said about if you want to get a HELOC, you could have access to that money. So I said, well, so we bought a hobby farm. We needed that outbuilding to be able to house our animals properly. And in order to make that dream of making this hobby farm work, we really needed that building. So we decided to go ahead and spend the money. So I went to this TrueStone Credit Union. I was approved for a HELOC of $33,000. And after I improved this outbuilding, I actually got a new appraisal done in a couple years later, and it really did improve the value of the property. It made me start to think, like, if I took a HELOC out, I got approved for a HELOC, and I used those funds only to improve my house, it's basically using your own equity to create more equity, right? So like if I created a new bedroom in my house and it improved the value of my property by $5,000 or $10,000, and it cost me, let's say it cost me $10,000 to do the project, and it improved the value of the house by $10,000. Well, I've taken from the equity I already built up by making payments on my house, and I used it to make my house better. So I get to enjoy the improvement right away. And I've increased the value of the house so that my loan to value ratio is improving, so that if I ever needed to get another HELOC or a higher limit, the bank would say, sure, this sounds like a great idea to us because you're using this well. You're not blowing the money on lottery tickets or going to the casino. You are using this to improve your property, to pay off debts, to finance purchases. Makes a lot of sense. Consolidating your debt. So anyways, I paid down that balance over about 9 months, got it down to fairly low. And the way I did it was I did what's called paycheck parking. I got that paycheck direct deposited in there. And when that balance got down considerably well, I was like, well, this is interesting. I have more money I can spend if I have other projects that come. Well, we ended up needing a vehicle. So used the HELOC to buy the vehicle and repeated the process of just using the extra funds that I had available every month. So I should take a step back. This really only works if you're not living paycheck to paycheck. You need to create cash flow first. You need to have money left over every month, or else it's really not going to matter if you have a HELOC or not. You really don't want to be underwater each month and running things through a HELOC, because your balance is just going to increase over time. And because you have more money you can spend, it doesn't place the same level of urgency on you to make enough money to have extra. Whereas if you're running this financial picture just through a checking account, you can't spend what you don't have unless you're using credit cards, right? And so when you switch over to velocity banking, you do have to remind yourself that your goal is to continue to pay down the balance by improving your cash flow. So can you make more money each month? Can you cut your expenses each month? Is there a way to improve your cash flow? Because the better you do on improving your cash flow, the quicker all your debts get paid and the more cash flow you unlock, right? So I was able to make some more home improvements, which also increased the value. We redid a whole kitchen, basically a whole main level. And it just came to the point where we got used to running our finances through the HELOC. All right, here's my second example. After about a year or two, I think, I got into this mindset of this is the way to do this. Well, all of a sudden, we see this rental property going to an online auction in our community at a very low price. But the catch was you could not just finance it with a normal mortgage. You had to get a HELOC or have cash. You had to have some way of making the entire payment at the time of sale so that you could win the online auction. So we renewed our HELOC. We just went back to our loan officer and said, hey, actually, this was with the credit union. Went to the credit union and say, hey, is there any way we can get a larger HELOC? And so we looked at where the house value was, got a new appraisal done, got, with all the new improvements, it was like, wow, this is a really nice appraisal. And then, therefore, we were able to go up in our HELOC limit up to 93,300. At that point, we were then able to use that limit to buy the rental property in cash because we had $70,000 in our HELOC. So we won the online auction, bought the property, and over the course of 6 months, we spent about $35,000 more. And we used some of our savings. We used our cash flow each month. We were cash flowing, $1,500 a month or something like that. So that helped us pay it, but we got very tight. I did not follow the 66% rule in this case because I needed to get a renter in this property so that it would start cash flowing. I really wanted to get somebody in there so I wasn't paying all the bills and not getting any income. So I pushed the limits on my HELOC. I even pushed the limits on my credit cards and got it finally renovated and I got a renter in there. After that, I went back to my loan guy at the credit union and said, I bought this property free and clear. I just need a first lien HELOC and I'm going to do velocity banking. I didn't tell him velocity bank, but I said, would it be possible to just get a first lien HELOC on this rental property that I own free and clear? And he said, yeah, that'd be totally fine. He said, we'll just give you $75,000. And I said, sweet. So what I did was I tried to take the expenses from the rental property and transfer them over to the HELOC that was on the property. And then I took the income from the property and direct deposited it into the HELOC that was assigned to that property. So it was kind of a more complicated system because now I'm running my personal finances through a HELOC for velocity banking. And now I'm running a separate velocity banking strategy on the rental property. Now, the only thing I didn't care for about that strategy was that compared to a 30-year mortgage, the interest rates fluctuated, right? And as a rental, you kind of know you're just going to be using it as a rental as long as your cash or your what you charge your tenant is above your payments, your expenses. Does it really matter that much if you have a 30-year mortgage, a 15-year mortgage, or a HELOC? And really what I came down to was a desire to have a locked-in interest rate, and I was able to actually access some of the equity that I had created or that we had created by renovating the property. So we ended up doing a cash out refinance. We closed the HELOC, paid it off, and got a 30-year mortgage at super low interest rates when it was still low back in 2021. And now that's on a 30-year mortgage. So I wanted to make it a little simpler, took the HELOC off of that. But now I'm at a place where if I wanted to, I could go back to the bank and say, I've got some equity in this property. Could I get a HELOC on it if I want it? I don't really need it right now. All right, so covered that. And then after a little while, I was able to use my home equity for my primary residence to buy a tractor, an RV, a used one, not a super fancy one, and then another couple vehicles. We had one vehicle hit by a deer in the middle of the winter or some springtime, had to come up with funds for that, and needed a plow truck to plow our driveway. So anyways, we got into this position where we had the funds available because we had a HELOC. We were wise with our money. We were paying it back. Every single paycheck was paying it back. We were able to continue to purchase things that had value. Even if it's a vehicle and it's losing value, it does serve a purpose to us. So we were able to keep investing into those things. We were pay that off slowly but surely. And then the market crashed, March of 2020. Now, I didn't go all in, but I did see some opportunities. I had about 10 different companies I've been tracking, and I bought some stocks in all 10 of them. And I said to myself, this has got to be about the bottom of the market. We'll see what happens. Well, sure enough, I was within a week of the bottom of the market, and I held those stocks for about a year, sold them out in 2021, and got an over 100% return of investment. I just wish I'd had the guts to go a little bit more all in on that. But I was a little concerned, all of us with COVID, we were a little concerned. So I did not invest as much as I could have, but I did make a really good investment because I had a HELOC. I felt comfortable putting that money at risk or lock it up for a little while. The other thing I've been able to do is get into the infinite banking concept, where you take a whole life insurance policy with a mutual insurance company, and you can access the cash value equity in your policy to make purchases like car purchases, whatever you need to do with it. But basically, it's a place to store your wealth where you get a guaranteed return instead of putting it into a savings account at a bank and getting really minimal in interest rates for that deposit. So I will cover the infinite banking concept in other videos, but in order to get started, you've got to make some premium payments. And so I use my HELOC to make infinite banking concept payments, which is once a year. So that is creating another asset that I can use throughout the rest of my lifetime, and then have a legacy I leave to my kids, because a whole life insurance policy is guaranteed to pay out to my kids. It doesn't matter if I'm paying the term insurance or not. And so that felt to me like an awesome opportunity to be able to tap into that. And then as cryptocurrencies got more exciting in 2021, I jumped in on that a little bit. Obviously, we're at the end of 2022. The cryptocurrency market has taken a nosedive, and things don't look quite as great in that market. But in general, it gave me the flexibility and the comfortability to at least be looking for opportunities to invest my money. All right, let's fast forward a little bit to earlier in 2022. I was approached by a business owner who was looking to sell her business, and it was as a therapy business, which I'm a mental health therapist. I've been working as an employee for other people for a long time. Enjoyed my job, didn't really have a big problem with any of it, but I was given this opportunity to purchase a business. And so I was able to use the funds from my whole life insurance policy plus my HELOC, and I was able to get some seller financing from her to purchase this business back at the beginning of this year. It did put me in a situation where I didn't have as much flexibility in my HELOC. I was getting pretty close to the limit, and I didn't really want to do that for very long. I didn't want it to negatively impact my credit score. And when you own a business, you're in a totally different setup. You don't have maybe the same salary payments or paychecks that you normally would. And so for a little while there, I was actually taking a lot less money for income because I wanted to build this business to be able to function better without me being so hands-on. So it took a little sacrifice at the beginning. So I went to the bank and I said, I just bought a business. I'd rather just increase my HELOC than do anything else. I had the opportunity to maybe borrow from my retirement funds or try to get a business loan, and none of those are really panning out the way I wanted them to. And so I just approached my bank and said, or the credit union, and said, is there any way I can get a larger limit? And they said, yeah. So that's where they offered me this ability to go up to the 175,000 without an appraisal. And so I expanded my credit line by another almost like $80,000 more. And so it's just been a huge blessing to have that opportunity, to have that safety net. I mean, really, as a business owner getting started, I was pretty new to the concept. I've been studying business for a while, but not officially at a college or anything like that. And when things were tighter, it was stressful, and I didn't like how that felt to put the stress on my wife and my kids, and just kind of grumpy. So to have this ability then to have a buffer was amazing. It's been great. It's allowed me to have the flexibility to start new projects, to really grow the business that I bought instead of just trying to white knuckle it where it's currently at. And so now what I'm doing is I'm branching out. I found that I really love to teach. I have some strategies I love to share with people. And so just trying to create more opportunities to teach people about these things, and really try to help more people to master their finances instead of feeling like their finances are getting the best of them. So here's how you can start. first of all, you need to know, is velocity banking with a HELOC a good option for you? And I think it really just depends on your financial situation. This video is not meant to be financial advice for you. It's meant for you to kind of think a little bit more openly about other options. But you do need to have a few different things going for you. You need to have a good credit score. You need to have equity in your primary home. So if you bought it on 5% down or nothing down, you're probably not going to qualify for a HELOC. You need to find the right lender. So building a good, rapport with your local credit union is really important. And then you also kind of need to know your own limits when it comes to controlling your spending, because sometimes, to be honest, the ability to spend makes you say yes to things you wouldn't normally say yes to. And you end up buying more things that you don't really need. And so you do need to maintain the same mindset with the HELOC as you would if you were paying with cash, because you do need to make sure you're still cash flowing every month. That being said, it does allow you to have the ability, the flexibility to buy things at a time that you maybe wouldn't have been able to. And sometimes those opportunities are a make or break situation when it comes to investments, or if it comes to, let's say you needed to go to a funeral across the country and someone really important to you had passed away. I mean, you need to come up with the funds for that, right? It's necessary. Your car breaks down, it's necessary. It's like you need to have like this framework in your brain that I'm living below my means and spending less than I earn. You need to defeat the Parkinson's law that I talked about in a previous video. So, and then to summarize everything, I just want to say, like, this is not for everybody, but if you are in a place where you want to take your finances to the next level and you want to have some capital available to you to invest with, or you want to finish paying down your debts, you want to speed up your debt snowball with just getting these things knocked out so you don't have those weighing on you. Or even if you want to pay off the rest of your home mortgage really fast, I think velocity banking is spectacular, because really what it does is it takes away a lot of the risk that you have with putting all your extra cash flow into your mortgage. Just think about this for a second. If you're trying to pay off your mortgage, you are putting a lot of extra money each month into your mortgage payments to reduce your total interest you're paying. But as you make those payments, even though you're creating equity in your loan balance, you do not have access to those funds. And so what ends up happening sometimes is that you have to live at almost poverty level for a while before you can pay off your home. And then when you get your home paid off, oh, now I could live like a king. Well, in reality, it is more risky, because if you for some reason lose a job, can't work, even if you've paid your house down to 85%, 90%, the balance that's still due is enough for the mortgage company to foreclose on your house, and they will take the entire thing, even if you owe them money. Or owe them less money, hardly anything, right? They're going to still be able to take your whole house, even if you owed $2, right? I mean, not that that would happen, but I feel like with the HELOC, as you make extra payments, and let's say you chunk that money, that monthly money, towards your existing home mortgage, as you pay it back, that money is available to you then to use to make another chunk. So if you decide I'm going to make a 12-month chunk, and you figure out your cash flow and you say I'm going to just plop it in, you really vastly improve your interest payouts, your volume of interest payouts, but you also create more space in your finances as you make those payments back. So it allows you to have the flexibility. If you can't make a chunk when you think you could, or something happens in life, you have options. And really what I go for in my finances is options. I want to give myself options. I want to give my family options. I want to give my kids options. In general, the more options I have, the more I can do, and the more I can learn about what the right thing to do is, the more I can make those wise decisions and follow through on it. So the last thing here is I am offering anybody who is able to do this and wants to do this the opportunity to send me your numbers. There's a link in the description below. It'll take you to a Google form. If you give me your email and you answer the 6 or 7 questions I have on there, I will email you back with an opportunity, or not an opportunity, with an analysis that'll tell you whether this is a good opportunity for you or not. Just basically looking at your debts, your monthly payments, your credit score, your loan to value on your house, that sort of thing. So I'd be happy to help you with that free of charge. So follow the link in the description below for that. If you have questions or comments, I'd be happy to converse with you in the YouTube comment section. So feel free to release or to let me know what your questions are. At this point in time, I would leave it open for questions. I'm checking really quick here to see if I have anybody with questions. Check here to see. It doesn't look like I do. So what I'm going to do is wrap this up for now. But if you do have questions after watching the video, you can certainly leave those comments in the description below, and I'd be happy to answer them. So thank you so much for